You walk into a theater of lights and screens. Tickers run like heartbeats. Numbers blink green and red like a pulse you can't quite read. You think it's a game of charts and chance. You think the odds are the same for everyone in the room. But beneath the glow, a different script runs. A script written for the few. A script rehearsed long before you took your seat. And you are the actor who didn't get the script. You improvise. They already know the ending. Level 1. The hidden toll. You place an order. You picture it moving on a public exchange. Fair and fast. A clean auction, best price wins. Nothing hidden. The truth is uglier, quieter, invisible. Your broker pockets payment for your order flow. They route your trade to whomever pays them most. Not to the venue that gives you the best price. Not to the exchange with the tightest spread. You become the product. Your intention to buy or sell becomes data someone else monetizes. This fee, payment for order flow, creates a pipeline to market makers. They make money by capturing the spread. They see your order before the wider market does. You think you got a market price. You likely paid a hidden cost, a few fractions of a cent, repeated millions of times. And the broker? They walk away with a handshake. Except it's legal. It's just not yours. The disclosure sits in a footnote you never opened. The confirmation email never mentions who paid whom. You signed up for zero commission and paid in a currency you couldn't see. Multiply that fraction of a cent by every trade you'll ever place, and it stops being trivial. It becomes a quiet tax collected on every click of the button. Level 2, the speed advantage time, is measured in microseconds. A server sitting a few miles closer to the exchange is worth millions. Firms pay for the privilege of proximity, rack space beside the matching engine. High-frequency traders co-locate in data centers. They shave milliseconds off your trade. They see the order book before you do. They send a tiny counter order that moves the price a hair before yours lands. You click, they have already profited. This is not accidental. It's engineered, built floor by floor, cable by cable. Fiber lines are shortened, then replaced by microwave towers for a few more microseconds of edge. Latency equals leverage. You are playing chess with someone placing 10 moves in the time you blink. Every millisecond you lose is money you never knew you could have kept. The race isn't between buyers and sellers anymore. It's between machines built only to see first and move first. You never see the race. You only see the result. Already decided, dressed up as a normal fill. Some firms spend fortunes shaving a straight line through a mountain just to save a few feet of cable. That's how much a fraction of a second is worth to someone who trades for a living. To you, it's invisible. To them, it's the entire business model. Level 3. Front-running and layering. They can read the stream. Patterns form like footprints in wet sand. Large orders leave trails, predictable and slow, broken into pieces that still rhyme. Someone with speed and access reads the footprints. They step in front of your trade. This is front-running. It's illegal when done with inside knowledge, but the gray is wide. Algorithms detect the shape of a big order without ever seeing its source. Then there's layering and spoofing, fake orders that never intend to trade. Stacks of price levels that look like real demand or real supply. They move the market to a zone where the real players bite. Orders appear, the price changes, and the fake orders vanish before they can be filled. You chase a shadow. You buy high because the tape told you a rush was coming. They sell into your panic. Your loss, their harvest. The screen never says, "This was fake." It only shows the price, and the price already lied to you once today. Regulators find the obvious cases, the sloppy ones that leave a trail. The quieter versions blend into normal noise and are never flagged at all. You are left reading tea leaves that someone else brewed on purpose. Level 4. Dark pools and hidden liquidity. You believe the exchange is the market, but vast volumes hide in the dark, away from any public quote. Dark pools are private venues for big players to trade out of sight. They match orders away from public quotes, matched at a reference price nobody negotiates live. It reduces market impact for the bigs, letting them move size without moving the tape. But it also removes transparency. You think a tight spread is the whole market. You don't see the iceberg beneath the waterline. Dark pools can be selective, choosing which orders they'll even interact with. Some orders never surface, filled and gone without a public trace. The price you see is a curated sample, the visible tip of a much larger iceberg. The full picture? They keep it under wraps, license by license, disclosure buried in filings few read. Even the venues meant to protect you can quietly work against you. Some pools sell information about the flow passing through them. You think you're invisible in there. Sometimes you're the most visible thing in the pool. The name suggests secrecy protects the small trader too. Mostly it protects whoever's order is large enough to need protecting. Level 5. Internalization and broker conflicts. Your broker routes to an internal desk. Your order never touches an exchange. It's matched internally with the broker or an affiliate on the other side. That's efficient for them, cheaper to process, faster to settle. It can be efficient for you, sometimes, a marginally better price on a quiet day. But it creates a conflict of interest baked into the plumbing. There's no transparent competition, no public bidding for your order. Your trade becomes a negotiation behind closed doors, and you weren't invited to the table. Did you get the best price, or the price they chose to give you? How would you know? The math that decides your fill lives inside a black box you'll never audit. You signed agreements written by people with the pen, and the pen was never yours. Best execution sounds like a promise. It's really a standard, and standards can be met while you still lose a little, every single time. Reasonable diligence is the phrase doing the heavy lifting in every agreement you skimmed. Reasonable to whom, exactly, is a question the fine print never quite answers. Level 6. The rebate game and maker-taker exchanges pay rebates to liquidity makers. They charge takers who remove liquidity. This maker-taker model warps incentives from the ground up. Market makers chase rebates, not fair price discovery. Orders are fragmented, bounced around venues hunting rebates, a few fractions of a cent at a time. Your order might be sliced, diced, and routed like a parcel through a dozen warehouses before delivery. Optimization of fees becomes the goal, not your execution quality. You think the exchange is neutral, a plain marketplace with plain rules. But each microfee tilts the playing field a little further from you. Small edges compound into systemic bias, repeated billions of times a day. Different exchanges offer different rebate schedules, and routing decisions quietly follow the money, not the trader. The exchange competes for order flow the same way your broker does. You are the flow being fought over, not the customer being served. Multiply a fraction of a cent by every share traded in a year, and the fraction stops looking small. The rebate war has a name for its casualties, though nobody puts it on a statement. It just shows up quietly, as a slightly worse price than the one you thought you saw. Level 7. Regulatory blind spots and institutional power regulators write rules on paper. Markets move faster than enforcement. Complex strategies hide in legal loopholes drafted before the technology existed. Big institutions build teams to test those seams, probing for what the rulebook forgot to say. They lobby for rules that favor sophistication, arguing complexity in the name of efficiency. They fund the systems that make them richer, then fund the studies that defend the systems. You pay taxes, fees, and spreads. They pay engineers and lobbyists, and both are investments that come back with interest. When flash crashes happen, they are often the calm in the storm, pulling liquidity exactly when it's needed most. When you lose, you're blamed for risk-taking. When they lose, the system changes to protect them, circuit breakers built after the fact, for the next time. Enforcement actions arrive years later, a fine that reads like a rounding error against the profit it followed. The rulebook keeps growing, and the loopholes keep growing faster than the rulebook can close them. By the time one gap is patched, 3 quieter ones have already opened. The people writing the next rulebook often trained at the firms the rulebook is meant to restrain. That isn't a conspiracy. It's just how expertise concentrates, and who ends up in the room when the room really matters. You are not powerless, but you are uninformed, and uninformed is a condition, not a sentence. The theater of the public tape hides backstage operations most people never think to ask about. Understanding the tricks doesn't make them vanish, it makes them visible. And visibility is leverage. What to watch? Read your broker's disclosures, even the parts written to be skipped. Check order routing policies. Published quarterly, rarely opened. Ask if they accept payment for order flow, and ask what percentage of orders it covers. Demand execution quality reports. Some brokers will actually produce them if asked directly. If they won't show them, walk. Use limit orders to control price. Know that market orders surrender control to whoever fills them. Consider brokers that send orders to public exchanges, not internalizers, even if the marketing is less flashy. Shop for execution quality, not commission headlines. A 0 listed on your statement is not the same as a 0 cost. What to do differently? Break big trades into smaller orders, so your intention doesn't announce itself. Don't broadcast intention. Patience is a form of protection. Use dark liquidity blocks when available, on your own terms, not someone else's. Time your trades. Avoid moments of known volatility, earnings, open, and close. Be skeptical of shiny 0 commission ads. Zero commission is often paid for elsewhere, quietly, in the price itself. A cheaper headline doesn't mean a cheaper trade. Read the fine print the way you'd read a contract, because it is one. A warning: Rossovers. The system wasn't built to ruin you. It was built to be efficient for specific users. Those users happened to be wealthy and fast, and speed itself became a product you can buy. Every layer of efficiency they add increases asymmetry somewhere downstream. Regulation tries to keep up, arriving late, aimed at yesterday's exploit. But technology moves faster than legislation, and it always will. This will not be fixed overnight, and no single reform will close every gap at once. You stand at a choice: become a smarter participant, or stay a convenient counterparty to someone else's profit. Knowledge is currency, and it compounds the same way money does. Skepticism is defense. Small changes reduce bleed, order by order, year by year. Collective scrutiny shrinks the shadows. Attention is the one resource they can't buy back from you. The curtain lifts a little. You now know the tricks. You can see the routes: payment for order flow, co-location, spoofing, dark pools, internalization, fee arbitrage. You can see the actors: brokers, market makers, HFTs, dark venues, exchanges, regulators, arriving late. You can see the incentives that steer the entire show, quiet as they are. You are not alone in being surprised. Millions thought the lights were real, and most still do. You have a choice: to learn, to ask, to demand answers, instead of accepting silence. Sharpen your tools. Use orders that limit harm. Pick brokers who prioritize execution, not cash kickbacks dressed as convenience. Trade like you own the balance sheet, because in many of these trades you do, whether or not anyone told you so. Final shot. You close your laptop. The tickers keep humming, indifferent to whether you're watching. You no longer see a neutral market. You see an engineered system, built in layers, defended in filings. You see the ways the game leans, quietly, consistently, in one direction. You see the exits. You see the front doors. You see the doors nobody bothered to label. Now you choose how to move through them. The theater lights stay on either way, but you're no longer just watching the show. End.